All right, before we get into some more stuff dealing with internal controls, I wanted to take a quick set and really talk about three things, and that's liquidity, cash, and cash equivalents. We use cash so much in the past chapters and all through this one that we've really never specifically talked about what cash was. Also, we're going to talk about cash equivalents, and then what's this concept called liquidity. That's what we're going to start with first. So, what is liquidity? And I'm sure you've heard of some businesses having a liquidity sale. But liquidity refers to a company's ability to pay its near-term obligations. In layman's terms, it's how quickly can we get something converted into cash, because cash is what's needed to pay our near-term obligations. Cash and similar assets are called liquid assets because they can be readily used to settle such obligations. The most liquid asset that you have is cash because you don't have to do anything to convert it to cash. It's there. But there's some other things, like if you had land. Land is not very liquid because in order to do that, you have to sell it, and then there's a whole process with that. So if you remember, I told you back in, I think, chapter 1, we talked about there is a specific order in which you put assets on the balance sheet. It is actually liquidity. It's in the order of liquidity. That's why cash always goes first, is because it is the most liquid asset that you have. That's what's referred to as liquidity. Now let's talk about cash. Cash is, yes, it is what you're thinking of. Cash, the greenbacks, the currency that we have. But it's also some other items that are payable on demand. It's not simply just, $1, $5, $10 bills. It's other things as well. It's the things that are converted to or transferred immediately. So again, before I go on to the next one, you can think of it kind of like a debit card. A debit card's cash. A check is a cash. There's plenty of other examples of what cash is. It doesn't necessarily have to be just the currency. Now we have what's called cash equivalents, and cash equivalents are a little different. Cash equivalents are like cash, but they're kind of investments too. These are short-term, highly liquid investments that have to meet two criteria in order for them to be classified as cash equivalents. One, they have to be readily converted to a known cash amount. Well, that takes out stocks and that takes out Bitcoin and all the cryptocurrency, because I don't know what it's going to be over the next week or when I'm going to actually sell it. I don't know that. It's very volatile. Also, it needs to be sufficiently close to the maturity date so that the market value is not sensitive to the interest rate changes. So these are things that really only going to be used, are investments that are for typically about 3 months. That's what's going to be your cash equivalents, are going to be highly liquid investments that are only good for about 3 months. You're not going to keep them for longer than that. That's what's going to satisfy these two criteria. So when you hear cash equivalents, that's what it's referring to. Appreciate it.